Hello and welcome to MF Cafe. I'm Sumaira Abdi and here's wishing all our viewers a very happy Diwali. The mutual fund industry is at that 25 lakh crore rupee mark, and much of that growth has actually come in the last 5 years, and perhaps the next 25 lakh crore could easily come in the next 5 years. That's the kind of growth that is being projected, and this is being driven by the scores of retail investors who have chosen to keep the faith and remain invested. Although the pace of investments perhaps could have been coming down in the last few months, but the money is still coming in, and that remains a heartening fact. This Diwali, we wish you prosperity and patience. And my three guests today, MANOJ'S, FEROZE'S and KAUSTUBH join me in echoing that sentiment, because they have come armed with some mutual fund picks for you this Diwali. So gentlemen, thanks so much for spending Diwali with us. And I know that over the last few months actually we've seen that NAVs have been dropping, but nevertheless we are seeing signs of retail investors who have continued to invest and have also taken advantage of these lower levels. Therefore, what is the best advice for them this Diwali? What are the picks that they should be betting at? Manoj, let's start with you.
Yeah, so the way we look at it is that the retail investors have been continuing the faith in mutual funds, and at this point of time, because of the great fall in the market, some of them are shying away from the funds. One of the top picks that I advise people to look at is the ICICI Blue Chip Fund. This is a large cap fund, manages volatility very significantly. In the last 10 years, 9 years, it has outperformed the markets and created alpha. The style of the management of the fund has now been distinctly identified. There is significant overlook on it by Shankar Naren, though he is not the fund manager now. He was the fund manager of this fund till last month, but now it has changed. However, the value of the fund still remains the core. So that, if you're looking a large cap fund, will be a core holding, should be a core holding of the mutual fund portfolio for a retail investor to begin with.
Alright, so that sounds good. Feroz, what about you? What have you chosen?
See, I have chosen Mirae Asset India Equity Fund. It's a largely a multi-cap fund with a huge focus towards large cap. So almost about 85 to 88% of the money is in large cap. But I think in the new regime, giving the flexibility to the fund manager is going to be far more critical, especially when there are diverged performance between mid-cap and large cap. So much so that 15-20% of divergence has become a norm. So I would rather delegate this decision to the fund manager, point one. Nilesh Surana is the fund manager, and he's done a great job from 2014 when he took it over. I think his style is bottom-up stock picking, and I think that's very crucial. Running any fund, especially a multi-cap fund, you need to be more bottom-up. That's one. And I think he have been able to keep the risks limited and have been able to deliver returns, risk-adjusted returns significantly. They have about 67 stocks, 86% in large cap, 12% in mid-cap. I think that will be my pick on the large cap, multi-cap kind of a fund.
Alright, and there's a big case to be made actually for smaller funds given the kind of rise that they have seen in their asset base. Costa, what about you? You told me you're going to really look deep and find some unique funds. So what do you have for us?
So I wouldn't say it's unique, but it's a name that's kind of fallen off the charts for a lot of people. The HDFC Top 100 Fund, right? It was a very popular fund to start with, but over the last few years, it's kind of taken a little bit of a volatile ride, and let me explain what's really been happening, right? So if I look at the strategy of the fund, it's fairly simple. As Prashant, who manages the fund, calls it growth at a reasonable price. Essentially looking at growth stocks, but he doesn't want to overpay for that. So that's really the crux of where he's coming from. But where he really differentiates himself is a couple of points. One is that he's not really looking at the benchmark when he's constructing his portfolio. So you'll see significant underweight or overweights versus the benchmark, sort of the stocks that he owns in terms of proportions. That's one key element that he brings in. The other thing, which actually has worked both ways for him, and it's probably hurt him over the last few years, he's a little early cycle investor. He's got this knack of identifying cycles a little ahead of the curve, but it takes time for the market to maybe acknowledge that fact, and he's taken and bore the brunt of that. And I think that's a great thing to do as a manager, where you've shown your patience, you've shown your conviction, and he's stuck on with for instance some of the corporate bank names that he had, including SBI and on the PSU side, that he's been holding on to that conviction. He's been early cycle, and some of the technology names that he's been adding over the last few years. So definitely, I think in a space like a large cap fund, he would definitely be one of my top picks as a manager.
So Prashant, conviction gen, not for nothing, right? And he's put his money where his mouth is, so he's heavily invested also in his own funds. All right, let's get more picks. Feroz, what is your second pick?
See, I think one thing which is going to be very different from the previous Diwali is a new carved out category, which is the focused equity fund.
Right.
So I think in the large cap side, because the stocks you're holding are reasonably stable, focusing on fewer stocks definitely gets you that alpha, and I can still keep risks significantly limited. In that category, my favorite pick would be the ICICI focused equity fund, managed by a very stable fund manager who's been doing fund management for about 10 years now. Runal Singh manages that fund with just 12 stocks on the large cap side. That's the most concentrated equity portfolio you will find in the mutual fund category. PMSs can be very easily replaced with this fund. The speciality of this fund is, in spite of concentrating into 12 stocks, the standard deviation, as is a measure of risk, is lower than Nifty. So it's not just high risk, but it's concentrated, controlled risk with alphas on Nifty in a situation where most funds have underperformed Nifty. This fund has outperformed Nifty by a few percent.
All right,
that's my pick.
And therefore, this fund actually also makes the case solid for this entire category, right?
Yes, I think it really does, and this category has not got the attention, so it has only about 600 crores in this fund. So a smaller fund has the agility to move. I think concentration needs to come with agility. If you don't like a stock, you should be able to dump that stock and move on to better ideas. I think because of its size and the good fund manager pedigree, because the same fund manager manages ICICI Value Discovery, which is a 16,000 crore fund. So it's not a new kid on the block. It's the guy with a stable track record, and I think this will be the fund, to my mind, I would bet my money on.
Yeah, and increasingly it seems like everybody with conviction seems to be doing well. KAUSTUBH, what's number 2 on your list?
So Feroz really nicely explained about a concentrated strategy. I'm going to take it to the other end of the spectrum, a more diversified strategy, and then explain why. So the Birla Frontline Equity Fund. Mahesh has been managing this fund for over a decade now, and if I look at the way that he really manages this strategy, he's looking at it from a sectoral level, kind of mimicking the benchmark, but stock selection is really where the key to the strategy lies, where he can takes those stock calls within benchmark names and some of the off benchmark names where he can really add a lot of alpha. The other interesting element that he brings in is, while he's a buy and hold manager, he uses an element of his long-term picks to trade. And in a market like this, where we have seen dips within months of 10-15% on some really good quality names, he can actually go move in and out of those stocks, and he's done that. So that's that just adds that little bit of element of alpha and brings out a differentiation in the strategy, which otherwise would have been a very sort of benchmark aware sort of strategy. So these are a couple of really strong points of the strategy, and obviously Mahesh brings the execution capabilities to the table, and there's something that we should definitely want to look at from an investor's perspective.
Yeah, and the more I hear you guys speak, the more I'm convinced of the argument of how essential a good fund manager is to the performance of a fund, and this is something that we've been advocating to retail investors as well as one of the most important metrics to judge. So Manoj, is your next fund also something which is driven by the fund manager?
Yeah, so the next fund that I will put on the table is the Kotak Contra Fund. It's managed by Deepak Gupta. The reason we are putting this fund on the table is that it was earlier known as the Kotak Classic Equity Fund. However, the way if you analyze the markets at this point of time, the rally has been led by PE expansion. Now the PEs have expanded to a level where further PE expansion is now difficult. So the next 5 years are really going to see earnings growth, and those stocks which are driving the earnings growth, those kind of funds will outperform the generic funds. A Kotak Contra Fund plays on this psychology, identifies value bets, at the same point of time keeps it fairly diversified, and their track record in the last 5, 6, 7 years has been impeccable, especially the last 3 years when most of the funds have failed to beat the category benchmarks. This is one fund which has consistently beaten category benchmarks. So these 3 things put together, we feel Kotak Contra Fund, because of the value cycle emerging in the next 3 years, could be a good thing to look at.
Alright, so that makes sense. We still have 2 more picks each to go. So KAUSTUBH, I'm going to start off round 3 with you. What do you have for us?
So I want to go down the capitalization curve and talk about a mid-cap fund. And now this is a category which has seen a lot of flows come in We've seen the rise of 2017, and obviously 2018 has been a very difficult year for investors. So my first advice would be that, it's still a great long-term sort of wealth creating category. You just need to have the patience. This is very much a part of the market cycle where you will see dips. We all know small and mid caps will be more volatile than a large cap, but you just need to identify the good managers and stick with them. So one of the managers we really like in the space is Janki Raman from Franklin, so the Franklin Prima Fund. Now if I look at the strategy again, one of the clear focuses when Janki and the team at Franklin are really looking to identify stocks is look at quality businesses and look at good corporate governance practices, because that becomes even more paramount in a capitalization space that he's operating in. So he's looking at robust earnings growth and just visibility of earnings and some other metrics that he would identify as good quality sort of practices that are there. He tends to build a more diversified portfolio. So you would see typically even his largest bets would not exceed 5%, and that's really driven by the fact that because you don't want to be overloading on a segment like mid caps, and that's why he's taken that very conscious call to kind of make a more diversified portfolio, about 50 to 60 stocks. When I look at the way the fund's done, it's done extremely well over a market cycle. But the one sort of caveat I want to give is that when there are spurts in the market where there's momentum at work, this fund could potentially lag, but in a long run or a good market cycle, this fund should do exceedingly well. Just that quality focus is going to drive home the returns for this manager.
All right, Manoj, you're up next. What do you choose?
Well, for people who want to really take a higher risk, one of the themes we believe will play out in the next 5 to 7 years is the infra theme. Infra has been a bad name for the last 10 years now. Most of the funds have underperformed the markets. At this point of time, we see a great revival happening in the government spending, which has already happened in the last 3 years, and private capex is starting to come in. We feel that, and the signs of recovery are now clearly visible in each of them. So our top fund here is the IDFC Infra Fund. However, it's only for a person who wants to take that higher beta risk into the portfolio, wants to, add an incremental alpha, and understands that this may or may not play out, and this is a probability thing. So if you are keen on all these things, a high risk taker, IDFC Infra Fund could be a good bet to put in your portfolio.
All right, and that's interesting because we've seen some of the infra companies this quarter report absolutely stunning numbers, and not just that, a lot of people are now seeing value in a lot of these beaten down cap good names, steel, etc. So perhaps Manoj, you could be giving infra a good name, right? All right, Feroz, you're up next.
See, I think if you again look at, I personally don't prefer thematic funds because the conventional large cap and the mid cap funds also skew their portfolio to the sectors which are already lucrative. Like a lot of funds move from different sectors to IT and pharma a year back. So if I'm going to buy myself a sectorial fund, then I'm going to be double doing the same thing which the fund manager might end up doing. So I would go the mid-cap way, and I'd say Kotak Emerging Equities, which is managed by Pankaj Tibrewal, 3,000 crore fund, well diversified but largely focused on mid-cap stocks, is a good fund because if you evaluate a fund manager on the mid-cap space by the capability of decision making, and if you see the last 50 decisions done by Pankaj Tibrewal to see how many went right and how many went wrong, which we call right to wrong ratio, that I think is phenomenal when it comes to this gentleman. So I think the fund manager's job every day is to buy and sell. So if he's taking decisions, you can go to the root cause of the performance, and rather than analyze the effect, you analyze the cause, and then you know that the future performance might sustain if the capability is favoring you. So this will be my fund, Kotak Emerging Equities, on the mid-cap space, diversified.
All right, and once again we see that you're convinced by the ability of the fund manager in your choice of fund. All right, so what we'll do now is take a very quick break. We'll come back in a bit. There are more mutual fund picks for you, and in case you're wondering how our experts have managed to narrow down their top choices to just 12, we'll tell you all of that up next. Stay tuned. Welcome back. You're watching MF Cafe, and our three experts are hand-picking 12 mutual fund ideas for you this Diwali. So you know you don't have to do the hard work because they've already done it for you. So we've discussed 3 of your picks each. Manoj, what's the 4th pick that you have for our viewers?
Yeah, so one of the important things I always tell people is that one should diversify not only across various styles, large cap, mid cap, but also across geographies. So our last pick comes across here, and we recommend the Franklin India US Opportunities Fund. As the name suggests, this is 100% invested into the US markets. It's a 4 billion fund managed out of the US by Grant Bowers. It has stocks which are like Amazon, Apple, Google, Microsoft, MasterCard, Visa, all the things that we use in a day-to-day life. And this fund has given a return of almost 18% CAGR over the last 10 years plus. If you're an Indian investor and you want to compare returns with global markets, mostly people think that global markets don't deliver returns comparable to emerging markets and specifically Indian markets. However, this clearly proves to you that the US markets, and especially a stock portfolio in the US which is constructed significantly. For example, this portfolio is constructed with the underlying stocks which have a 20% CAGR in terms of EPS year on year in US dollar terms. So now we compare it to Indian companies. Indian companies are also not delivering a CAGR of 20% plus at this point of time. All this put together, it makes a very compelling bet that you should look at US markets to invest in, and one of the US funds. We recommend the Franklin US Opportunities Fund because of its strong pedigree, long track record, and a portfolio which is fairly well diversified. It benchmarks itself up to the Russell 3000 index, which is a very diversified index, and not just to the Dow or Nasdaq, which are very smaller indices to look at. And it has been performing well in line even when compared to the Russell 3000 index. Specifically, these funds give you a hedge against the currency. It gives you performance. It gives you an exposure to the world's largest market, and we continue to believe that US markets will continue to expand their earnings growth going forward. A lot of people think that the last 3-4 years the markets in US have done extremely well, and that now will slow down. We on the contrary believe that this is the beginning of the bull phase for the developed markets also, and US markets will lead the rally. So when you are constructing your portfolio, don't forget to do a geographic diversification, that this should be a strong thing in your portfolio.
Yeah, there's no doubt that US is growing, and the jury is out on whether the rest of the world is going to keep up with that. So that's good. And also for everybody who'd like to have dollar exposure, if you have kids who are looking to go abroad, this is something that you should consider having in your portfolio. And with rupee at 73, a good bet for NRIs too, right? Feroz, what's next for you?
For me, on the mid-cap side, again a focused strategy, which in these kind of markets where mid-caps have taken a beating, a 27 stock portfolio which is called SBI Focused Equity. R. Srinivasan is the fund manager, and I think he has, over the last 8 years, 9 years in SBI, created a niche for himself in terms of stock picking, and I think concentration with a fund manager has shown and picked up stocks much ahead of the curve is a very good strategy. So there's so much value which has emerged. That's where a SBI focused equity fund has 27 stocks. Largely pharmaceutical stocks have supported him, and has about 40% of these 27 stocks in the large cap category. So you get a mix of large and mid, largely focused towards mid cap, but I think this fund has the potential to outperform both the large and the mid cap indices by about 4-5% a year.
So that's a good selection, and SBI as a fund house as well looks to be really roaring now, so that's not something that investors should be ignoring. Kaustubh, finally the last pick to you. What do you have for us?
Sure. So Manoj spoke about diversification. I want to take that back to the Indian diversification context. So far we've spoken about while we had a contra strategy, there's another value discovery fund, which again which Feroz touched upon as a manager. So clearly we find space for a value strategy within the investor's portfolio to sort of complement the growth styles which a lot of managers run. And the clear case in point is what happened through 2018, right? 2017 was a very bad year for this fund because this strategy wasn't really, it was the market cycle which didn't really work. But 2018, classic case in point, where this fund's been doing relatively a lot better as compared to it, simply because of its value tilt. How does Mrinal manage this strategy? So for starters, the whole thought process at ICICI has always been contrarian. So Naren driving the process has been sort of contra against the market, and they found that really nice niche for themselves there. And Mrinal sort of mirrors that thought process. So if you look at the way the portfolio has been constructed, he's overweight on technology, pharmaceuticals, and he's been overweight on these counters for a very long time. It's not just a recent up move, and that's obviously helped him in these market conditions. So that's really one of the picks that we think should be a nice complement to an investor's portfolio.
All right, so that makes sense. So you have handpicked 12 ideas for investors this Diwali, but the one thing that everybody who's watching the show now wants to know is how would you look at this entire universe of mutual funds and actually just decide on the top, say 4 for each of you, and therefore what should be the learning for retail investors? How can they do the same? So Feroz, what would you tell retail investors when they're looking to actually just pick the top 4 funds in their portfolio?
See, I think when it comes to mutual fund selection, there's a clear evidence that people generally pick up mutual funds from a rear view mirror perspective rather than looking forward, you're looking backwards. And if you think of a mutual fund, it's nothing but a basket of shares which have been grouped to and given a name with a fund manager. But if the same share, if it's in your demat account and if it doubles, you feel like selling it. But if it's a mutual fund portfolio which has doubled, you feel like buying it. So it's counterintuitive to do different opposite actions to the same asset wrapped under a basket. So we try and, as advisors, bring down the bias of past performance, and in fact statistics have subjects which help you crystal ball gaze better than looking at the rear view. So we use something called regression to choose a fund, because the universe, like you pointed out, it's so large that it can be very confusing to pick up 1% of the total. You're picking up 1 from 100 available options. That's a tough task. So if I give you illustrations of what variables have a capacity to indicate the future, if not to perfection, better than past performance, one of them we use is called you pay a value for the growth. So you see price to earnings divided by growth. I'm just giving you an example. So that's called the PEG ratio. With this ratio, you can compare different geographies, different funds on the same apple-to-apple comparison. So that's one variable. The second variable is we interact with the fund manager for years and record their top picks and high convictions and see how their virtual portfolio is doing. We create a virtual portfolio for each fund manager after every interaction, so that you have 10 years of a virtual portfolio created to understand if it was fund manager's money, what would he have done with it and how did it actually perform. Because mutual funds come with a lot of restrictions, but an open canvas gives you a good picture of the fund manager's credibility. If I put some numbers on perspective, there are about 140 odd equity fund managers. After doing this analysis of their correctness in decision making, to my mind there are only 21 fund managers who qualify to be called fund managers. That's a large statement to make, so it's important to look at the front windscreen rather than the rear view mirror.
Yeah, Feroz, we don't want you costing any jobs this Diwali. Alright, Kaustubh, what would you tell people?
Sure. So, we follow a philosophy, and Feroz, I think, very rightly pointed out that the rear view mirror sort of, looking at past performance can be more harmful than good. Because you tend to make irrational decisions at times. So at Morningstar, what we really do is drill down to understanding the strategy and the strengths of a manager and a process. So obviously we'll want to understand the implicit strengths that a manager brings to him. So we spend a lot of time meeting managers, doing our own background research and how he's managed a portfolio in the past. So while it's a starting point for us to see what he's done with his portfolio, that's only to have a conversation with the manager to assess what are his skill sets. In what area of operation does he really excel in? To give you an example, there will be managers who will be really good managing large cap strategies. Does not make him an automatic good mid cap manager. Now that's something we need to kind of ascertain when we catch up and understand his style or his philosophy. The other thing that we try to do is not just understand the manager, because he's the one who's finally the face of the fund, but the team that's supporting it, because that's another very important aspect. He's not a single man show who's running it while he's the public face to it. There's a large team of analysts, so we need to understand really what's the longevity and things like that. Spend time with them, understand their investment research process really to gauge how robust and strong it is. And why is this so important? If it's a fund manager driven strategy, if tomorrow he's not there, the fund could sink. Now I'm not saying that the manager does not bring value to the table, he brings immense value, but you can shepherd it if you have a strong backup team in place. And we've seen instances where great managers have left and the fund's really gone through a rocky patch, and at the same time there have been places where it's kind of been business as usual almost, with someone else stepping into the shoes. So I think understanding the people behind it, the process, it's very important. We also do things like understanding performance attribution. So Feroz kind of alluded to it, that are they really doing what they intended to do, right? And I can when I look at his past performance, and we've met him over years, if he says I'm a buy and hold manager, and we're seeing that's a lot of churn happening, then there's some dissonance between what he said he would do and what he did. So that we would really try to understand what are the levers behind his decision making by doing a lot of X-ray analysis of his portfolio decisions over the past.
All right, so maybe under promise and over deliver works, right?
Absolutely.
All right, Manoj, you've been asked this question so many times about how investors should pick, but not investors. Tell us how you would pick for mutual funds.
Sure. So we look at broadly three variables. I think a lot of variables have already been covered by Feroz and Kaustubh in depth. So one clearly is analyzing the people behind the fund management who are there. So understanding their biases, understanding how they are managing the funds, are they true to label? So that part is significant. The second part, an overlay has to be on top of it. How is the current market environment? The same fund manager who may be impeccable in a, or will be performing in one kind of a market environment may not be able to deliver in a other kind of a market environment. That does not mean that the fund manager does not have the skills. As advisors, as investors, we all need to understand which fund manager will be able to navigate the next leg of market environment effectively and generate returns for you. So that's another variable that we try to overlay, saying that how does the market environment pan out. And the third and the most important thing in the entire scenario has to be, what is the risk that the investor is willing to take. You have to marry the risk that you are willing to take, the goals that you have set for yourself with the other two factors, which is the fund management expertise and the market environment. If you see, all the four picks that we laid out on the table have varying different levels of risk, and it does not mean that every investor should buy all of them. Investor now has to choose, saying that if these risks are varying, what is the kind of tenor that you are going to look at, and how are you able to digest volatility going forward. So these are the three broad variables that investors need to keep in mind, or work closely with an advisor and construct a portfolio. The last step, which is constructing the portfolio, how much you allocate to each fund, is also very, very significant. This is a classic example a lot of people give, that if you have 5 funds, 2 investors have the same 5 funds but in different weightages, their returns will be completely different. So the portfolio construction is the last part, but a very important part investors should look at it. Most of the investors just go out and equal weight by buying 3 funds equally or 5 funds equally, and some even go up to the extent of buying 20-30 mutual funds, which is just the wrong strategy to do. Ideally have a core portfolio of 3 to 5 funds, weight them according to the risk you want to take, identify different investment styles for each of the funds you choose. Don't try to get all the funds with the same investment style. This is one more mistake which Feroz rightly identified, saying that people just look at the last 1 year performance, and if you choose funds based on that, you are ultimately going to end up with funds which are just the same style in your portfolio, which does not help you at all in case of diversification. So these are some of the points I would want to leave investors within this Diwali, and construct your portfolio wisely and stay safe.
Gentlemen, thanks so much for brightening up our Diwali with your mutual fund picks and for your advice through the year. We wish you, your colleagues and your families a very happy Diwali. Thanks so much for watching this episode of MF Cafe. Here's wishing all of you a very happy Diwali, and we do hope that retail investors will continue to invest the faith and remain invested in this journey for long-term wealth creation. Happy Diwali.